Good evening, everybody, and welcome to our Reprogram Your Mindset program. Reprogram Your Mindset session. So, my name is Edwin, and I'm a trainer at EGM Securities. With me is Matthew. He's a trainer as well. And welcome to the session. So, on today's session, we will be looking at risk tolerance. So when you talk about risk tolerance, we are trying to gauge the level of or our ability, like how much risk can we afford to take in the market. So it therefore refers to the amount of loss that an investor is prepared to handle while making an investment decision. So the big question is, as you trade, how much risk are you comfortable taking with your trades? So we have three types of risk tolerances. So the first one is the aggressive kind. So these types of traders are characterized by taking huge risk in the market. So they're well versed in the markets and they're usually ready to take quite a huge risk in the market. So they're not worried about the level of risk that they would take. And when it comes to trading or when it comes to investing, they are accustomed or they are used to seeing wide movements in the market. So when the market makes huge moves, when the market is very volatile, they are not worried by how far trades move towards the losing side. So they have a high tolerance towards risk and they are able to hold on to their portfolio with the hope that the investment would come around and they would recoup some of the money that they would have lost. Not necessarily lost entirely, but if, for example, the portfolio that they are holding had ran into too much loss, they are willing to tolerate that and wait for the portfolio to come round. They are in most cases wealthy and experienced. So for you to have the capacity to have your trades running into a significant amount of loss, you need to have a significant amount of capital to cushion your trades. So most of these traders are characterized by huge amounts of capital, and they are in most cases quite experienced. Then the other characteristic is that they try to reap superior returns when the market is doing well, and they face huge losses if the trades that they've taken do not pan out. So as you're well aware, with huge risk, then in some cases, you're bound to also make a significant return. So when the risk is huge, in most cases, such assets can also give you an equivalent amount. They can give you a significant amount of reward as well. Then lastly, they are not quick in panic selling. So as we have stated or as we have seen, they have a huge tolerance towards risk. So they're not quick to offload or to liquidate their positions when they are in loss. So they are able to hold on to their portfolios, awaiting for the market to return back to profitability. And this is because such traders are accustomed. They see things, they see these movements every other day. So they are able to tolerate because they see these fluctuations almost every other day, and so it's normal to them to have such movements happening. Then we also have the moderate. So with the moderate, it's the in-between. These are investors who are willing to take risk, but only up to a certain extent. So they are less risk tolerant in comparison to the aggressive kind. So the aggressive kind take quite a significant amount of risk, but the moderate take some sort of measured risk. So they take some risk, and this is usually in such a way that they set their risks to a certain level. So they take measured risk. They're willing to take the risk, but only up to a certain level, which they can handle. So it's a balance between risk and safer assets. So they balance their portfolio in order to include the risky assets as well as the assets which are deemed to be a bit safe. That being the case, they therefore earn less amount of money than the aggressive kind. So their returns are less as compared to those of the aggressive type. So when they are suffering a loss in their portfolio, the loss is usually less as well in comparison to the aggressive type of traders. Then lastly, we have the conservative. So with the conservative, these are the most risk-averse type of traders. So they go for the safest options. So for example, they might decide to invest in bonds because bonds happen to be quite safe. So their priority is to preserve their capital at the expense of profit. So they prioritize more on avoiding losses above making profits. So their priority is not profit per se, but to preserve what they have in the first place. And they also trade or they invest in assets where they feel that their capital is protected. So with these three types of traders, the aggressive take the highest amount of risk. Then they are followed by the moderates. And lastly, you have the conservative type. Now, the reason why we are covering these types of traders is to try and learn how risk may affect your portfolio. So here we have a comparison between risk and performance. So the whole essence of this chart is to try and see how we can balance between these two so that we do not end up taking too much risk, which might end up adversely affecting our portfolio. But then again, in some cases, you may also notice that traders may be too risk averse such that their trading patterns may also compromise their growth, because when you're too careful, then it means you're foregoing a return on your investment. But then again, when you're taking too much risk, then it will also, you also run the risk of having your portfolio affected negatively. You run the risk of losing quite a significant amount of money. So Mathew, looking at this chart, what would you make of it?
I mean, there's always an optimum level of risk and performance. Yeah, there's optimum level of risk that is going to give to or lead to an optimum level of performance, and it's just a balance. Just like you started by saying, being either too aggressive, not so good; being so much averse, not quite good. You just need a balance, and matter of programming the mindset in such a manner that you protect your capital, but not protecting it too much that you're not able to take advantage of the opportunities in the market, or maybe risking so much that you're not able to last long in the market and see the next day, next trading day. So looking at this, it looks like a bell-shaped, although it doesn't really conform to the interpretation of a bell-shaped, the normal bell-shaped curves that we use. But here I see where someone is at an extremely low risk. You're fearing the markets, yeah, and you're taking very low lot sizes. When you get a profit, you get some very little profits. So then you don't realize you don't realize the return of your capital in such a based on how you are invested, right? And become bored, become complacent. You are actually not generating as much profit, or not taking advantage of the market, just to put it very simple. Okay, and on the other extreme end is where you have someone who is taking excessive risk. Yeah, a lot anxious every time. You're worried. You're stressed out because you've lost. And those extremes is what someone wants to like bring to an optimal level. And that one, this is a sustained performance because the risk is contained. Sustained performance because in the fullness of time, or as time progresses, you've got some amount of profit or returns to show. But sometimes when you're managing a risk so much, but then the performance is so little that when you look at how much you have at the end of the month, it's not really giving you that return you won't be happy about as a trader. So I think it makes sense to me, Edwin. It's just a balance of the performance, right? A balance of performance in terms of risk allocation and taking opportunities in the market. So every trader has to find their balance. Okay, we're not saying that being risk averse is bad. No, you can be risk averse, but there are traders who would be waiting for very big returns. Okay, but take very few trades. Most of them are risk averse, and then the aggressive traders maybe want to take small profits and short-term frequent entries. Okay, because they are really very fast into the market, and they also make profits. But again, there are consequences in both ends. So it's always a choice to make, but a balance is better. A balance is better because I feel it's more of a modest trading approach when you are at an optimal level. Okay, not too worried, but again, not too complacent. Not making too much money, but again, not making very, very, very less or very little money. Okay.
Yeah.
That's what.
Yeah. So as you rightly pointed out, it's basically all boils down to finding your window of tolerance. Like, how much risk are you comfortable taking? So, for example, if you had to take the left side, the left extreme, I'll take it like a case where you have, like, let's say $10,000 in your trading account. You have $10,000 and perhaps you're trading with the least contract sizes of, let's say, 0.01. So the amount of capital that you have does not match the level of contracts that you're taking. So if you're taking the least amount of contracts, like contracts of 0.01, and you have like $10,000 in your account, those trades may be quite small for such an account. And as you continue to trade, the level of return that you'd expect with such an amount of capital may be too little. So those trades would be giving you a very little return in comparison to the amount of capital that you have. So in such a case, then that is what might bring about complacency or boredom. Because with such an amount, you'd expect slightly higher returns as you trade. On the other extreme, on the right extreme, it would be a case where you have a decent amount of capital. You could be having, let's say, $1,000. But then again, $1,000 account, okay, with $1,000 account, would you be able to trade standard lots with such an account? Such contracts, again, might be too huge for you to trade. So trading standard contracts with $1,000 account might again be, you might be overshooting. And so trading that within, it would mean that you're likely to have that anxiety because the rate of loss or the rate at which you're likely to lose your money with such trades is quite huge for such an account. Such a capital may not give you enough cushion for your trades to run into maturity. So ideally, we are therefore trying to find that balance. So what is the window of tolerance? How much risk is too much risk? Depending on a number of factors. So some of the factors that may come into play is one, the products that you're trading, because the product does affect risk, Matthew. So if, for example, you're trading oil and gold, how do these products move? Do they move the same way as currencies? Do they move the same way as indices?
Maybe a little bit of the common aspect of having US dollar.
Yes.
Right? Mm-hmm. So that is a correlation you have. That's the factor which is bringing them a little bit of a relationship. Yeah.
Mm-hmm. Mm-hmm.
Yeah. So I think that's something that a trader needs to understand. Something that trader needs to understand, so that you know, as an aggressive trader, or what's really likely to expose you to excessive risk, what's likely to expose you to very little risk. Okay, actually, just for you to be a balanced trader, you need to understand the financial instruments you're trading on. Yeah.
Yeah, because
they move.
With assets like gold, oil, pound pairs, you will notice that such products tend to be quite volatile. So as you trade, you need to balance between the contract size and how far you want to set your stop loss, so that you can be within your risk limit. So even before you start to trade, you need to ask yourself how much, as I was introducing, we said that you need to identify how much risk is too much risk. So what is your risk per trade? As you continue to trade, what is the maximum amount of loss that you tolerate per trade? So for most traders, they strive to retain a risk per trade of less than 2%. So depending on the kind of product that you're trading, how are you balancing between the allocation of stop loss or the allocation of the number of pips that you lose? Should that trade end up in loss in relation to the contract that you'd want to take? So again, depending on the profile of the asset, then that you may find that for some assets, you may need to trade in small sizes and increase the margin so that you can accommodate heavy volatility in the course of the period that you will hold for such assets. Then the other component that comes into play is the amount of capital that you have. So the amount of capital that you have will also affect your risk, because if you have more capital, it means that you can afford to trade bigger sizes of contracts, or you can also be able to trade small sizes but have the opportunity to take too many trades. You can have, you're able to diversify with different assets when you have a significant amount of capital. So you can trade few with significant contract sizes, or you can as well have the window to increase the number of assets that you're holding at any given point in time, and have a large pool or have a wide portfolio of assets which you have traded at one point in time. Then the other component that comes into play is the market conditions. So what is prevailing in the market? Because in some cases, you will notice that the market tends to be volatile, especially when there's uncertainty. So for example, when there's turmoil or state of unrest, like we have now, due to the war that is prevailing between Russia and Ukraine, then you will notice in some cases you may have some huge volatility with some assets. So what are the prevailing market conditions? And depending on the level of volatility that that is prevailing in the market, then that can also affect how you balance between risk and your trading profile, basically. Matthew? So now, when you are trading on the FX Pesa platform, it's a matter of you setting the product based on your level of tolerance. So you have to understand your personality, and as you set your trades, you should be able to know how much risk fits your profile. So I'm just trying to pull the FX Pesa platform. Matthew, can you be able to see to see my FX Pesa platform on your side?
No, you've shared a different.
Okay.
You shared a different. Now we can. Now I think it was there. You can go back and log in.
Okay. Just bear with me.
No, let's just take time to show us on the platform.
How about now?
Yeah, you can see.
Yeah, so on the FX Pesa platform, We say that the first thing is to know the level of risk that you're comfortable with. So when it comes to the execution of trades, as you set your trades, you're basically trying to balance the contract size. So this is where you place the contract size. You're trying to balance between the contract size and the amount of loss. So if, for example, you are trading this asset, so if you're trading this pair, as you trade, it's a matter of you balancing between your contract size and the amount of pips that you'd set as stop loss for that trade. So what you will notice is that if you trade two small sizes with a big account, so if, for example, you were to trade a contract of 0.01 with a decent amount of capital, you will notice that the amount of return that you'd make might be quite small. So for this particular pair, you'd make around 10 cents. So 10 cents per pip might be quite small for such an account. So that is what we are saying, that then the amount of capital will also determine how much risk is too much. On the other hand, if you had a very small capital, and let's say you've taken a contract of 2. So 2 standard lots for this particular contract would have you make or lose $20 per pip or per single step movement in price. So again, if you have low amount of capital, let's say $1,000, then it means that with $1,000, if that trade was to move by, let's say, 50 pips, you've completely wiped out your account. So as you trade, you therefore have to find the proper balance between the contract that you trade. So as you said, the contract size of your trades on this particular slot, you'd also try to balance that with the margin for the pips that you'd want to set for that trade, so that you'd have a trade whose stop loss is within a reasonable margin to give it enough room to play out. But at the same time, if that trade does not pan out, then you wouldn't lose too much money, which your account may not be able to handle, or you wouldn't want to dent your accounts or your capital too much. So basically, that is what we mean by finding the window of balance between the risk that you're taking and the expectation that you'd be targeting for profit and loss as well. So basically, that is it, Matthew, not unless you have something to add.
I mean, I'm actually here listening to you. It's so interesting that just waiting to hear the wisdom coming straight from you. So it's all about reprogramming the mindset and trying to balance on both extremes. There's no one extreme which is good, but most of the time you'll find traders with their risk profiles along those extremes. And well, different traders are able to put up with various risk profiles and risk environments they're trading. So it's a case that someone can argue for or against. But for us, I think, and for me, having listened to you, I think I would say a balance is always better. Yeah. A balance is always better. and take, and of course, someone with balance is able to prevail even in various market conditions, right? You're able to survive in various market conditions when there's a lot of risk, when there's low volatility. I mean, that's a balanced trader. And do you think that a moderate or a trader who is like balanced or moderate, with not quite aggressive, not very risk averse, don't you think that trader lasts longer in the market? Edwin?
It should last longer in the market, because again, yeah, it's all about your personality. We all have different personalities.
Exactly.
So it's just about finding the right balance.
And and I think what we're looking for in this market is being able to make it a livelihood, being able to make it something like a profession that you can comfortably sit and say, I am doing forex trading, and you're able to keep to it because you've got the discipline. You can survive at any condition of the market, any environment, right? So that's awesome, Edwin. Today I didn't have much to add into the conversation. It's quite clear and very, very succinct. So up to this point, I think then we can call it a session.
Yes.
Okay. All right then.
All right.
Thank you so much, guys, for attending, and see you next time. Bye.
All right. See you.